Okay, so it looks like attendee numbers have stabilized now. So once again, thank you for joining us and welcome to the TI Ocean and Air Freight Tracker Outlook webinar for Q1 2024. This is actually the fourth edition of this webinar now, so we've made our anniversary. So thanks for those of you who've been with us that whole time for joining all these sessions. Today, we're hoping to give you more great insights on the development and really the year ahead for both air and ocean freight. What's the outlook on pricing and what's feeding into that in terms of the supply and demand mix? And obviously, I mean, it feels like it's permanently like this now, but there have been more very interesting developments over the last quarter, of course, all talking about what's going on in the Red Sea and what are the sort of medium to long term expectations for that, and obviously what's the immediate impacts. Obviously now we're into March. I think we've got to grips with the immediate effects of it. So it's more about looking at when may this unwind and what would it mean for the year ahead, really. That added to that is also the Panama Canal and the capacity issues that's causing with the lower water levels there. So lots of stresses and strains on capacity, which you might say, fortunately, up to now, of course, capacity hasn't been too much of an issue. We've been in a very oversupplied market for capacity and demand's been quite low as well. But as we're starting to see demand creeping back into the market, it's interesting to chart through how that balance will look when we get towards the end of this year. And that's what we'll be trying to help you with today. So the session will be about 30 minutes long, as usual. And then we'll be having a Q&A session afterwards. So please do feel free to ask questions in the Q&A app as we go through, and we'll come to them at the end. In addition to that, we'll also have two polls, which will be asking you your views on rate development in both ocean and air freight rates as we look at the poll data and the outlooks. So please do, prepare to answer those polls during the webinar. We'll be starting with ocean first, and moving on to the air freight side after that. Okay, so now I think it's time for me to welcome my panelists. So I'm joined today by Vicky Kekarowska, TI's freight team leader, who's instrumental in writing a lot of the analysis and bringing an understanding of the markets to this webinar, and indeed the ocean freight tracker and the air freight tracker that sit behind it. So welcome, Vicky.
Hi, everyone.
And also, let's welcome Janan Hassan, one of TI's economic analysts. And Janan manages all of the data that supports all of our analysis today. So without her, we wouldn't be able to do much analysis at all. So welcome, Janan.
Hello, everyone.
And I'll introduce myself once again as well, of course. For those that don't know me, I'm Michael Clover. I'm your host, and I'm TI's head of commercial development. And I'll always be very happy to talk to you about any questions about any of the data and findings you see today, and to see if you'd obviously be interested in subscribing to any of our long-term data subscriptions. I'm certainly happy to help you with that. Okay, so without further ado, let's move on to our first content slide. And as I mentioned, we'll start with ocean freight, and heading up on rates, we can see the overall picture here, and the marked uptick we can see there on rates, showing really the impact of the developments over the last couple of months and the Red Sea, really. But Vicky, could you just take us through what's happened, what's driving that, and what you're expecting to see?
Yes. Yes, Michael. So yes, as you said, a significant increase in January, especially on head haul lanes, and it's mainly the Red Sea disruptions that pushed rates up to their highest level in 16 months. And as expected, those trade lanes that typically experience higher levels of demand also experienced the highest rate increases. In terms of average cost, for instance, the cost of shipping a 40-foot container on major global head hauls has increased from around $1,400 to around $3,800 at the start of February. So that's a significant increase. And I said the main reason is the Red Sea crisis. So that means that ocean carriers have started diverting their vessels around the southern tip of Africa as a response to the attacks in the Red Sea, and they have injected capacity to compensate for the longer transit times, and also imposed emergency surcharges to cover those additional operating costs. But in addition to this, ocean carriers have also imposed emergency surcharges as a response to the drought crisis at the Panama Canal. We've also seen carriers imposing the carbon tax surcharges, so that's related to the emission trading system that came into force in January in the EU. And a fourth factor, the general rate increases that some of the ocean carriers implemented ahead of the Lunar New Year holiday. So these increased rate levels should obviously give ocean carriers leverage in contract negotiations. But it might also be the case that many shippers will try to defer their negotiations until the spot rates have settled somewhat.
Yes, thanks, Vicky. So interesting situation here, and obviously this is a global index, so this doesn't show the fully formed effects of the Red Sea crisis on the Asia to Europe lane, which is obviously most pronounced, although clearly it's global market and capacity situation affects all lanes as well. So if you're interested in reading that more specific analysis, that's where you'd need to download our full report on the ocean freight market. So I encourage you to do that as well. But we'll move now from just looking at rates onto an exploration of the demand side and really looking at port volumes here to see how that situation is changing as well. So, Vicky, could you take us through this one too?
Yes, well, in terms of demand, there hasn't been significant change. There has been only modest increases in terms of global volumes in both Q3 and Q4 of last year of around 1%. And this increase in volumes is mainly driven by the increases in Asia Pacific volumes. So overall demand from the Asia Pacific is one of the few bright spots in the demand picture, but this is mainly driven by the US consumer demand, which continues to be quite strong and resilient and continues to support the ocean shipping sector. And it's true that consumer spending in the US hasn't been as strong as in the first half of 2023 when consumers were spending their accumulated savings, but overall the spending is still quite strong and resilient, and we still haven't seen a recession in spending. Which is good news because Europe, on the other hand, provides little support for container demand. We know that most of the European economies are in recession, Germany in particular, and we might even say that the weakness of the German economy and European economies in general, that is the main reason why the Red Sea crisis has proved to be so manageable and that it didn't cause major supply chain disruptions.
Yeah, because the logic there, of course, would be if the volumes were higher, then we'd have much more of a capacity issue. So it will be very interesting to see if this goes on, how that can be managed as volumes do recover. We're starting to see that trend. Our expectations for later in the year, which we'll come up to later, are that will pick up further as the year progresses as well. So that's one of the key questions, really. All right. Well, we'll now move on to the capacity side of the market. Obviously, we've spoken a bit about that in relation to the Red Sea and also the Panama Canal. But Janan, could you just take us through the overall capacity situation in ocean freight?
Of course. So capacity has been rising steadily over the past year, and year on year there was a notable increase of 6.2% versus 2022. Quarter 4 in particular saw an increase of 12% versus quarter 3, while in February versus January this year, this growth has slowed to a more modest 1.7%. Capacity, however, still remains below the peak of June 2022, and since then there's been a notable decline of 8.5%. And the leveling off we see here in February is possibly due to the rationalization of larger container fleets and potential scrappage.
Yes, Thanks, Janan. So there's lots of capacity management still ongoing, even though obviously that extra required capacity has helped to sort of lift rates in response to the Red Sea crisis there. Now let's move on then to another supply side issue, looking at bunker fuel prices, obviously an important factor in rates, and Janan's going to take us through developments here too.
So yes, according to our latest data, bunker fuel prices have decreased from their peak in September 2023 across all regions. Globally, prices decreased by 3.7% versus quarter three, but compared to 2022, they increased by 9.4%. When we look at the regional level, Asia Pacific saw the largest decrease of 4.6% compared to quarter three. However, the year-on-year, it has experienced an increase of 9.7%. These are all interesting figures as we observed decrease when the year closed, but now current oil market dynamics are largely driven by demand concerns, and OPEC is forecasting a larger demand this year, and US oil refiners are operating at weak levels due to seasonal maintenance and unplanned outages. So it will be interesting to see how oil prices evolve over the next quarter.
Yes, and obviously to throw even more uncertainty into the mix there, we still don't really know the impact of the security situation in the Middle East on oil prices. Obviously, that's a massive downside risk if things do become more difficult in the region from a security perspective to oil prices increasing substantially. Okay, well, before we come on to the difficult business of predicting the way rates will develop this year, we thought we'd also share with you our latest sentiment tracker looking at rate expectations. And it's at this point that we'll be launching our ocean freight poll as well, asking you the same question really that we asked in this sentiment index. So please do, as you see that coming up on your screen, answer the question with your expectations of how you think ocean freight rates will change in the next quarter. But while we're waiting for those results to come in, Vicky, could you just explain how the sentiment tracker works and what it's showing at the moment?
Yes, well, the sentiment index is based on our poll data. So every quarter we survey industry stakeholders and we ask them what their expectations are for ocean freight rates on various trade lanes for the upcoming quarter. And according to the latest data, the most significant rate increase will be seen on the Asia to Europe trade lane, which is quite expected and can be attributed to the ongoing issues in the Red Sea. So to be more precise, more than 40% of respondents expected rates on this lane will increase significantly, and around 20% expected rates will increase moderately on this lane. And then on the Asia to North America lane, again, the majority of respondents, 38%, believe that rates will increase moderately. And then on the third lane, Europe to the US East Coast, there is no consensus there. The majority of respondents, around 28%, believe that rates will remain flat. But there's still a significant proportion, around a quarter, that believe that rates will increase only slightly. But taken together globally, most respondents anticipate a slight increase in ocean freight rates on all trade lanes.
Thanks, Vicky. And the results of our live poll are also in here as well. So just sharing those with you now. As you can see them, interesting that not a single respondent is saying that rates will increase significantly there, which is very unusual. But perhaps this indicates really that people think that now the rate increase is sort of priced in from the Red Sea crisis as we're becoming used to this situation. What's your read on that, Vicky?
Yeah, well, I think it just reflects the uncertainty surrounding the ocean freight market, not just in terms of demand, but in terms of capacity and the crisis crippling the industry. So yeah, definitely no consensus there. Ocean
Yeah.
say that it will decrease and increase. So yeah, I guess it will all depend on how the issue in the Red Sea develops, because in terms of demand, we more or less know what to expect. We know that demand growth will be slow, so it'll be mainly those supply chain disruptions that we're seeing that will determine how rates will develop.
Okay, thank you, Vicky. But in that case, we will move on to trying to give you a clear view as we can of the expectations for the year ahead on rates, notwithstanding all the uncertainty, of course. So this is our TI's global ocean freight rates outlook. And this is driven by all the metrics you see on the left-hand side there, listed into the categories of supply and demand side issues, and then the sort of supply side and logistics disruption and considerations which have been really shaping rate development over the last few years, really. The way that the graphic works really is that the bottom line there shows you the overall direction of travel we expect to see for rates, and the darker arrows are a more substantial increase, and the lighter ones are a more limited increase or a more limited decrease if they're the red downward arrows. The rest of the lines, they show you not how this will affect or how that metric is going to change, but instead they show you how that will affect freight rates. So, you know, if you're looking at issues around say the emissions trading system, you can see that's got an upward effect on rates because of the charges expected with it. So that's just how to interpret it. Obviously, you can see that we are and have been expecting the increasing rates that we've seen over the course of Q1. And then as we look to Q2, we're still expecting to see all these factors combine to suggest a slight uptick. But generally after that, a sort of flattening off of rate change as we enter a period where supply and demand is a bit more stable. That's assuming that the security situation in the Red Sea persists during that period, as we can't really see when that is likely to end. So that's the overall picture. But I will ask Vicky to offer her thoughts on, you know, other demand side factors and how they're influencing you know, rate development over the year ahead as well.
Yes. Well, industry stakeholders are quite optimistic for the year ahead, versus US retailers believe and forecast year-on-year growth in the second half of 2024. And ocean carriers as well, they believe that consumer demand will remain strong based on improving macroeconomic conditions such as GDP growth, lower inflation, low unemployment levels, and lower inventory to sales ratios. So with regards to the latter, the inventory data shows a mixed picture because different product group, different sectors show different levels of inventory to sales ratios. But overall, the data shows a decline in inventory to sales ratios over the past few months, which should suggest stronger than expected demand. It means that retailers should soon start their destocking phases. They should soon start replenish their warehouses. But as I said, this all depends on the sector.
Thanks very much, Vicky. Yes, and Janelle, would you like to add any comments on the expectations for supply side issues?
Yes. So the order books indicate an aggressive increase in container shipping capacity, raising concern over oversupply and potential price crashes in the future. On the bunker fuel side, OPEC forecasts a demand growth of 2.2 million barrels per day, and with it, the oil price will predictably rise. Although, like Michael said earlier, the current geopolitical climate definitely blurs the lines when it comes to using bunker fuel as an indicator to predict future trends in freight rates.
Yes, thanks, Janelle. So, you know, generally that characterization of the market as existing with oversupply is, as both Vicky and Janelle said, likely to be the dominant factor this year. And obviously with more vessels coming online, that's expected to outstrip demand. So that is likely to be the defining factor in the year ahead. Now, thanks very much for your insights on ocean freight rates. It's now time for us to move on to air freight. So we'll start off with a look at the overall global rate situation once again. And Vicky, could you give us your thoughts on the air freight rates?
Yes, well, TI's air freight index increased 9.3% in Q4 compared to the previous quarter. And rates in February are also up compared to January. And it's still difficult to tell what's driving this increase. It might be the seasonal demand before factories shut down for the lunar year holiday, or it might be the shift from ocean to air, which has been driven by the Red Sea crisis. And it was actually expected that the impact that the disruptions in the Red Sea would have a dramatic effect on air freight, and that demand for air freight services will increase significantly. But the effect was short-lived, and we've only seen short-lived increases in rates before they return to normality. And as I said earlier, it might be the weaknesses across Europe that are the reason behind this.
Yes. Yes, thanks, Vicky. Interesting. Lots of questions we've had about picking up on the modal shift and trying to find real data showing options for sort of sea, land, sea air combinations and so on. We've had survey data showing 6% of people are considering those kind of modal shifts, but don't yet see too much data on the ground to really see that borne out. And interesting to look at the rates as an indicator of that. Also suggests there's not too much real change taking place there at the moment, but we'll watch that as it goes on. We'll move now to the volumes themselves, and Vicky will take us through this too.
Yes, well, the rate increase is obviously driven by air cargo volume increases, which rose by around 9% in the final quarter of 2023. And overall, throughout the past year, we've seen a positive trend, and air cargo volumes have been quite stable and recovering gradually. In terms of the Q4 increase, this has been obviously driven by the Christmas peak season. And as we already mentioned, US retail spending continues to be resilient, and there continues to be a strong demand from certain markets in Asia, such as Vietnam and Bangladesh, which again could be related to the Suez Canal issues, as manufacturers, consumer goods manufacturers, and clothing manufacturers resort to air freight in order to get their goods faster to European markets.
Thank you, Vicky. Yes. So now if we turn to the capacity situation, we'll take a look at how that's affecting rate development as well. So Janan, would you give us your thoughts on capacity?
Yes, of course. So December saw a significant 10.8% rise in global air cargo traffic compared to 2022. Similarly, global cargo ton kilometers increased by 11.5% versus last year. December particularly saw a strong performance in available cargo ton kilometers, which is capacity, seeing a 13.6 year-on-year increase. This was mostly due to the expansion of belly capacity driven by the robust passenger demand. And that was the strongest annual growth performance over the past 2 years for available cargo ton kilometers. Total air cargo capacity globally increased by 11.3%. That's mostly driven by December's strong performance. Passenger services have experienced a mini boom, so belly freight capacity has surged over the past year, although the increases have been more moderate recently.
Yes, thanks for that. Interesting to see the big uptick in capacity towards the end of the year. And expectations for capacity to continue to be good in 2024. Obviously, yes, a lot of that belly freight capacity has already come online, but reading there's still plenty of belly freight capacity coming in this year, particularly on the Trans-Pacific lane as passenger travel from Asia picks up as well. So interesting to look at that situation, but again, improving capacity situation persisting then for air freight. If we turn to fuel, could you take us through this as well, please, Jeanette?
Yes. So according to IATA's data, the jet fuel prices decreased by 20% from their peak in September last year, and they ended the year at $104 per barrel. The average jet fuel price in the full year of 2023 was 19% lower than its 2022 average, although it remained 41% higher than 2019 levels. And despite relatively high jet fuel prices and air cargo load factors, air cargo yields and surcharges saw a slight increase of 0.8 in December, following a very significant rise in November. Overall, conflict in the Middle East and disruptions in container shipping have contributed to the upward pressure on air cargo yields. That being said, in 2023, yields decreased by 32% than their historic highs of the 2022, but remained 40% higher than pre-pandemic levels.
Great, thanks, Jeanette. So we'll now move on to our sentiment index again. This one works similarly in principle to the way that the ocean freight tracker works, and I will launch the poll for air freight rates for you now. And once again, just while you're answering the question on how you think air freight rates will change in the next quarter, I'll ask Vicky just to explain what the latest poll data from the survey used in the chart here suggests about the market. So take it away, Vicky.
Yeah, so on the Asia to Europe lane, the majority of respondents, around a quarter, expect rates to increase slightly. And then on the Asia to North America, the majority expect rates to increase moderately, with the second most common response being that rates will increase slightly. So again, a clear expectation that rates will increase on this lane too. And similarly on the Europe to US East Coast route, respondents expect that rates will increase slightly. So overall, the majority of respondents expect that air freight rates will increase slightly in the coming quarter.
Thanks, Vicky. It looks like most of our results are in now for the rates poll. So I'll just close then and I'll share the results with you. But in general, I'd say they reflect what's on the poll data from our survey as well, trending slightly more towards the somewhat increasing or flat side of things. What's your take on that, Vicky?
Well, it probably means that participants are convinced possibly that the Red Sea crisis will persist and might have a knock-on effect on air freight, because that's actually the expectation that if it persists, it might create congestion at European ports and shortage of containers on Asia ports. So if that happens, it's very likely that shippers might have to resort to air freight, especially for their urgent shipments.
Yeah, absolutely. And maybe that also mirrors other disruption, strike action at airports, not slated for German airports this year. Also disruption in South Africa, for instance, at airports. And obviously also modal choices around reaching the east coast of the US from Asia as well. Obviously lots of sea land options there, but potentially more shift to air as well. So lots of factors maybe leading to that continuing increase there. All right. Well, thank you everyone for participating in both those polls. Always appreciated. We'll now turn on to our outlook for air freight. Again, this works similarly in terms of principles of how to interpret it to the ocean freight chart as well, and it's all geared up around the metrics you see on the left-hand side of your screen on supply and demand and disruption as to what will drive rate increases. It's also a fairly similar picture in terms of our expectations for rate development. As you can see, we're expecting through the remainder of Q1 and Q2 to see an increase in rates, and that's sort of continuing through the year as well before things stabilize towards the end of the year as well. Perhaps Janan, I can ask you to come in on supply side issues and how we expect those to develop this year before we come to the demand side.
Yes, of course. So the supply side dynamics in the air freight market this quarter are ambiguous, as growth is occurring alongside moderation in certain regional capacities. A big factor is the rationalization of freight capacity, such as the large US-based express carriers, as it's occurred, but overall market capacity seems to be increasing. Factors such as manufacturing constraints and supply chain issues could potentially limit air freight capacity growth towards the second half of this year and the beginning of next year. In terms of fuel, the EEAI today projects that the Brent spot price will be $82.8 a barrel in Q1, but it will jump 6% in Q2 and then moderately rise in Q3 and Q4. That being said, while fuel price is a good litmus test usually for operating costs of airlines and rates changes, due to the current market uncertainties, it's very hard to rely on.
Thanks, Jen. Yes, always, of course, uncertainty there. But all right, Vicky, could you provide some comments on our expectations on the demand side as well?
Yes, well, air freight demand is only predicted to grow by around 1 to 2% in 2024. So there isn't a catalyst for faster growth on the horizon. And at the same time, capacity is expected to increase 2 to 4%. There are signs that US freight demand is normalizing, however, at lower levels, which means that the air freight market is rebalancing rather than rebounding. So that means we're going through freight market moderation.
Thank you, Vicky. Yes. All right. So the expectations are not for huge demand side growth for air freight, but for moderate recovery in demand and rates to stabilize. So thanks very much for sharing all that. That actually brings to the end our content for today. So thank you very much for listening. We now have our Q&A session as well. So please do feel free to ask any questions in the Q&A. If you think there's anything we need to cover, haven't touched on yet, please ask. We'll be happy to discuss those points. We do have a couple of questions that have come through already. So to start with, I will turn to those. So this first question we have here is looking at how the emissions trading system prices are calculated and how that's shaping the market. So, how is that calculated basically? So, Vicky, I don't know if you'd be happy to speak about that a little bit, about some of the impacts on the market.
Yeah, so the emission trading system that came into force in January this year, ocean carriers have already started implementing those carbon tax surcharges. And in terms of the actual cost burden or cost increase, it is estimated that the carbon tax will cost between 1% and 5% of freight rates, and obviously the majority of the cost burden will be passed on to the shipping company's customers.
Great, thanks very much, Vicky. Yes, and obviously lots of interesting ideas for how to manage some of those costs. Hearing about calling at different ports just outside Europe, for instance, to try and minimize costs if possible, and not naming any names, but there you go. Okay, next question is on, please discuss your views on the impact of current and persisting Panama Canal drought on the US East Coast rates. So yes, that's something we have vaguely touched on today, but we can discuss a bit further as well. But obviously, if you're interested in reading about that, then please do go to TI's logistics trackers, and you can get the full Trans-Pacific analysis as well, which obviously focuses quite a bit on the issues with the Panama Canal. But obviously, the main issue there is on causing a bit more of a capacity crunch as fewer ships can pass through the Panama Canal to reach the East Coast, and therefore causing more port congestion on West Coast ports, and obviously more cost in terms of moving that freight to its final destinations if they're having to reach East Coast ports as well. So clearly that's having a upward trend effect on rates across the Trans-Pacific, especially those reaching the East Coast. And honestly, we expect that to continue, and it take a while for that to unwind, even if the issues in the Panama Canal are solved by water levels coming back to normality. So we'd expect that to have a sort of upward pressure on rates for the next few months as well. Next question here is for both air and ocean, what would be the pros and cons of negotiating rates valued for 6 or 12 months? That's from Alex. So, I mean, Alex, one thing I would say is if you get in touch with TI, you could read our analysis of contract strategies and read some of our surveys on contract lengths. But I know that Vicky's been doing a lot of work on that recently. So, would you have any comments to make on how contract lengths are changing and choices around that?
Yes, but I would give different answers for ocean and air. For air, for instance, because volumes have been quite stable over the past year or so, I would expect that shippers would move to longer term contracts, fixed rate contracts. But with regards to ocean rates, because the spot rates are quite high now, mainly because of the Red Sea disruptions and the Panama Canal, I think that shippers will delay signing long-term contracts. They might decide to sign quarterly, simply because of this volatility, and just to wait until those rates settle a little bit.
Okay, thank you. Thank you, Vicky. There's a couple of questions on rates comparison and on the actual prices paid for rates. For those that kind of questions, I'd suggest going to the tracker reports and then even to the data dashboard where you can see direct price comparisons across different lanes to get comparisons sort of change over time. So please do get in touch with us about that. And then the next question we have is looking more on the sort of capacity side of the market. So obviously, there are lots of factors like Panama and the Red Sea causing capacity crunch, except for the fact that we have massive oversupply, as we've said already. But with demand increase to the end of the year, what are the expectations for the effect of that on rates? And maybe, Janan, that's something you'd like to come in on.
Yes. So we expect rates to have some upward pressure in the next quarter due to those supply chain bottlenecks. But it's hard to assess the impact as we don't know when those supply chain bottlenecks would ease.
Yeah. But overall, anyway, we do still expect that oversupply to outstrip demand. I think I was reading the other day that when you look at obviously the sort of extra capacity that's being required to deal with those bottlenecks as well, that's only 6%. We think that there'll be by the end of 2024 with the order books 24% more capacity than there was looking back to a pre-pandemic world in 2019. And that we're only really expecting the growth in volumes from that period to now to be somewhere 10 to 15% over that whole period. So there's clearly a delta between those and an oversupply issue, even so. Okay, another question here just come in. Do you think the 1-year outlook on air freight rates, I presume, reflects a normalized long-term view on air freight rates, or is the outlook still volatile? Well, of course, the outlook is volatile. I should say that our forecast scenarios assume that we won't see any sort of black swan type events which will change the current dynamics, such as an invasion of Ukraine, a pandemic, and so on. So they would assume that if the current circumstances persist, because obviously we cannot predict those kind of events, So generally, that's a normalized view of the current market conditions, obviously changing for expectations around supply and demand, and the way that we see the disruption that we see in the current market playing out. So, port congestion, container availability, issues around the Red Sea, issues around alternative routes, and of course, alternative modal choice and combination options for, say, dealing with the Trans-Pacific to East Coast. So they will factor in all of those issues as we can see them now, but they don't factor in another major global event which might change things a bit further. There's also, I think, maybe our last question here on what are the trade finance dynamics you see in H2 2024? Upward pressure on rates, on air rates, or downward pressure on ocean rates. Well, I mean, generally our expectations for trade finance over the second half of the year and really through the current situation is obviously with added security concerns and disruption in supply chains. The cost of those things is increasing. There's also lots of change in options around sourcing and changing of sourcing locations or China plus strategies and so on coming in, which cause a bit of disruption there. So, we're anticipating, a bit of an increase there. And I think the difference between the air and ocean outlooks on that really just reflects, obviously, the security issues around ocean freight movements at the moment when compared to air freight. Obviously not got the same expectations of potential attacks and that sort of thing at this point. So in terms of insurance costs and so on, there's a difference there really, and I think that would be our view on that. But obviously, if you've got further questions you'd like to ask about that, we'd be very happy to continue that conversation as well. Okay. Well, thank you very much, everyone, for joining the session today. Afterwards, we'll share with you, a recording of today's session, and also download links to download the full reports if you don't have those already. If you do want further details on the individual trade lanes and the backup data, then please do get in touch with us. We do have more detailed versions of the reports that look lane by lane at developments within the air and ocean freight markets, and also the underlying data is all available if you need to do any more serious benchmarking or create your own reports. So please get in touch with us if you have any questions or you want to find more information. And all that remains really is for me to thank you for joining us, and of course to thank our panelists Vicky and Janan for sharing their insights and views today. And we hope to see you on the next session. All right, thank you and goodbye.